Hi class, this is Liz Brown with Richland College. We are covering our chapter on fixed assets. Other names for fixed assets you might hear in the business world are PP&E, which stands for property, plant, and equipment, and also long-term assets. These are assets that we plan to keep for more than a year. We learned about inventory earlier. These are assets that we plan to sell to our customers and keep for less than a year. So the difference here is the fixed assets we intend to keep for a long time. Let's take a look at how we value our assets. We have the example in the book here, which tells us that purchase price plus sales tax, transportation, shipping insurance, now this is only shipping insurance, not insurance going forward, and installation are the cost of our equipment. What we're looking at here is all costs that we need to get our equipment ready for use. An example here in the real world is I had to get a dishwasher. So I went to a hardware store and I saw a dishwasher. Let's say it cost $500. If I walked up and gave the clerk $500 in a briefcase and said, I would like this dishwasher, would it be ready for use? With that $500 in a briefcase, would I be able to wash my dishes in my house? No. There is a purchase price. I would also have to pay tax. If the price tag says $500, I'm not allowed to leave the store until I pay the $500 plus the tax. I don't have a truck big enough to travel with the dishwasher, so I have to pay for transportation. I also have to pay for installation as I've never installed a dishwasher. All of these costs are things that I needed to pay to get that asset ready for use. Also, the dishwasher I have planned to keep for many years, so that is going to be something that's going to be a long-term asset that I'm going to keep for more than a year. Let's look at other costs that we have associated with our fixed assets. We can have certain types of expenditures, and we need to determine if they are going to be expenses or be capitalized. Capitalized means we record an asset. So what we're looking at is if we can extend the future life of an asset, that is when we are going to capitalize those costs. So a great example of this is a car. So let's just review this list quickly together. Repairs and maintenance. These are things that maintain at a given level. They benefit the current period. An example would be exchanging your windshield wiper blades. Those are going to benefit the current period. That cost would be expensed. Any large repair that increases future benefit, such as a new engine, would be something that we would capitalize or make those costs part of our asset. Any additions or improvements that also increase the future life, those are going to be capitalized as well. An example of this would be a home and adding a bathroom or a bedroom. And finally, legal defense of an intangible asset. These can be capitalized if the defense is successful. Let's move into an example on our depreciation. We're going to do the first year of straight line, the first 2 years of double declining balance, and the first year of activity-based. There are several other examples out on eCampus. Please be sure to take a look at those and also to look at the examples in your textbook. We have University Car Wash. Here is our cost of our new car wash machines. The estimated residual value, this would be the value that we expect to get as we sell it at the end of its life, which is 6 years. The machine life in hours is 12,000. Let's first look over here at our journal entry that we will do to purchase this piece of equipment. The journal entry would be equipment of $270,000 and cash of $270,000. This could also be an accounts payable. Now let's take a look at straight line. Straight line traditionally is the easiest way to depreciate a fixed asset. What we're going to do here is we're going to take the full cost, $270,000. We are going to subtract out the residual value to get us the cost minus residual value of $246,000. Then we're going to take the number of years, in this case 6, and we are going to divide the cost less residual divided by the years. That is going to give us straight line depreciation for each of the 6 years of $41,000. What we're going to see here is our entry that we're going to book. Depreciation expense, a debit of $41,000, and accumulated depreciation, which is going to be a credit of $41,000. Accumulated depreciation is a contra asset. It is going to act in the opposite direction of an asset, so it is going to increase with a credit balance. Let's also take a look here at what our balance sheet is going to do. We are always going to list our equipment at the price that we purchased it at of $270,000. Our accumulated depreciation will be a negative number that will decrease this balance to get us a book balance or a book value of $229,000. Let's take a look at the schedule. This is the full schedule. We're going to just do the first year together. There are a lot of other resources. Please take a look at eCampus. What we're going to see is we're going to see the depreciable cost, depreciation rate, our depreciation expense of $41,000. It's going to be the same over the course of the 6 years, a straight line in graphical form, and our accumulated depreciation. This accumulated depreciation is going to grow by $41,000 each year, and our ending balance in our balance sheet would be a net book value of $24,000, which is exactly what we want. It is our estimated residual value. Let's move into double declining balance. Most students find this to be the most challenging method. I feel that the hardest part of this is the residual value. We do not subtract our residual value out when we are doing this problem. We take our book value and we multiply it by our rate. Now our book value is going to change. It is going to be reduced by our previous accumulated depreciation. So in year 1, there is no previous accumulated depreciation, and we have a book value of $270,000. Our rate for double declining balance is going to be the number 2 divided by our years. In this case, that is going to be 2 divided by 6 for a rate of 33%. This populated here, this is the book value, $270,000, times our rate of 0.33333 to give us depreciation of $90,000. This is our first year. The next year, as we're seeing here, we have taken our $270,000 book value and decreased it by the accumulated depreciation from the prior year to get us to $180,000. To calculate our depreciation for the next year, we are going to take that book value of $180,000 and multiply it by our rate to give us depreciation of $60,000. Note that our straight line depreciation was $41,000. This depreciation under double declining balance is more than double in the first year and much more in the second year. What we have here, as we discussed, we have our beginning book value of $270,000. It has not been decreased by the residual. We multiply it by our rate, which is 2 divided by the years, so 2 divided by 6 in this example. And we get our depreciation expense, which for the first year is our only accumulated depreciation. The book value is going to be our book value less our accumulated depreciation of $180,000. That number is going to travel down here and be our beginning book value multiplied by our rate to get us $60,000. Now the accumulated depreciation is $90,000 plus $60,000 for $150,000. This makes our new book value $270 less $150 or $180 less $60. Another important thing to note is that as you get near the end of the life, you need to be sure that you do not go past your residual value. This amount of $24,000 you have to keep in the back of your mind, because if you continue doing this chart, it will go past that $24,000. So please be sure to take a look at that as you work these problems. Now let's take a look at our activity-based. We have 12,000 machine hours. In the first year, we plan to use 3,100 machine hours. What we have here is our cost less residual value, $246,000, and we're going to divide that by our hours. 246,000 divided by 1,200 gives us an hourly rate of $20.50. For year 1, we take our machine hours that we used of 3,100 and multiply it by our rate of 20.50 to give us 63,550. Let's take a look at the chart here. What we have is the given hours used multiplied by our rate, giving us our depreciation expense. Our accumulated depreciation, we are just adding up 1 year, first year and second year, first, second, and third year to give us our accumulated depreciation. I'd recommend using a T account to help you tabulate what your accumulated depreciation is over the years. I also like to take a look at this chart. This chart really helps show what's happening with our 3 types of depreciation. Straight line is just that. Every year is the same, it makes a straight line. Activity-based can change depending how much you use the machine, the van, whatever it is you're looking at. Our double declining balance is more than double straight line and depreciates very quickly and then slows down as we get to the end of the life of the asset. Thank you guys. I hope this was helpful. Let me know if you have any questions on the discussion board.